Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward at what might happen in the next week. And hopefully lots of great ideas and opportunities for you throughout the show. Well, the stock market moved to a new high last week as the S&P 500 came up to just a few pennies below the 3,400 level. That's a 55% gain from the March lows. And during that time, the Nasdaq moves up almost 70% and now has put on its 36th record of the year. It was a week, again, that saw a lot of rotation. The week before, we saw the financials and the energies moving up and the Nasdaq stocks, the techs, correcting, pulling back. And now this week, again, we saw a change as we saw tech stocks being bought again. In fact, Apple has moved up to a $2 trillion valuation plus, and other techs also moving up to new highs. Tesla essentially well over the $2,000 level, and with that kind of valuation, they should really name their next electric car the Tulip. Apple's gains well over $450 billion just in the last month. Well, that gain of $450 plus is more than the market cap of 493 other companies in the S&P 500. It shows you the extreme that's going on. First half of the week, investors mainly focused on the market hitting an all-time high and then ran into some pretty negative comments out of Powell in the Fed minutes. And the bad news we talked about was that the recovery just might take longer than they originally thought. Of course, good news, well, is it good news or bad news? Well, bad news comes and good news seems to be just completely not available at the moment, but it doesn't matter because the bad news is really what the investors want to hear because that means the Fed will keep stimulating. In the Fed minutes, they came out and that comments from the Fed minutes were really disappointing in some way because a lot of investors wanted to hear them say they were interested in doing yield curve control. But that really was not a comment that they made, and investors started to sell the market at that point around the FOMC meeting. But that was only some minor selling as there was another bad auction that came out on the 20-year. And while the FOMC minutes brought some selling, that bad auction really brought a lot of selling, and it appears that investors are clearly concerned about interest rates going up and the fact, can the government continue to print money and sell the debt that they need to in order to finance these huge deficits? Well, you got to wonder, with the adoption of MMT, we are clearly there as these radical policies now seem to be being installed no matter who is in control of the government. No one should really care about the auctions, right? You might as well just be printing. We're in this period of unlimited printing, and why do you even need to have auctions at all if you can just print? So deficits all around the world, they shouldn't really matter. Well, of course, I'm being sarcastic, as it seems that they don't care about the amount of printing that they do. But investors did get a little bit nervous when they saw that the markets were not receptive to the debt. The end of the week saw some change. The markets moved down on Thursday, and then overnight they saw some news come out that China was back on track with trade talks. So that kind of ended the overnight selling that we saw coming in on Thursday. And then Friday we saw some bad news out of the Eurozone that their PMIs were pretty bad. That brought some selling early in the day on Friday, but then Apple kept moving to the upside, and the NASDAQ strength just came in very significantly. Also giving the market a lift on Friday in the morning were some news that Johnson & Johnson and Pfizer, that they were both moving into late-stage trials on their vaccine for COVID-19, and that also has been giving some support to the market. But overall, the market here on Friday is really being well supported by Apple, and Apple split is next week for holders of record on Monday, so that brought buyers into the market, and Apple remains incredibly buoyant right now, seemingly not really mattering that since the earnings report and the news of the split, the stock is up $100. Absolutely incredible. For the week, the stock market, S&P 500 up around 1%. The NASDAQ gains around 3%. The Russell down just under 2%. So we have another market showing a lot of disparity. And I want to note that the Russell on our analysis for the short term is breaking down here. So we mentioned that in our Future Speak show on Wednesday that might be significant if that happened, the very, very first sign. And we've got very negative breadth in the market today, more than 2-to-1 to the downside on a day when the stock market is up, and of course being lifted by just a few stocks right now. So for the bond market, we have almost a 2-point move to the upside, coming up and hitting resistance. The 10-year yield's down about 7 basis points, and we don't think there is a lot more to the downside in yields, or not a whole lot more to the upside in the bond market. Gold market down small in what was a volatile, choppy week. The dollar up a little bit, which those seem to work inversely correlated. And the oil market is down about 50 cents on the week, as that hit one of its first bumps that we've seen in quite a while. That's the opening here, but I have a lot to show you in here, and I'm not done with this conversation right now about the stock market and stock market valuations. First, before I get to that, I want you to remember, please go to askSlim.com, explore our site, look around, subscribe here to the YouTube channel, click that notification bell, make sure you share it with people if you like what we have here, and also follow us on Twitter at askSlim. You want information about our memberships, write to Matt at askSlim.com, and he'll be glad to send you some information, even have a discussion with you about what our great offerings are. So write Matt, M-A-T-T, at askSlim.com for information on our memberships. All right, I've got some things to show you in here that I think are going to be interesting. We're going to look at 3 signs of stock market extremes. Now, maybe it's obvious the stock market is at an extreme with a 55% gain off of its lows and some valuations that we have not seen. So I'm going to talk a little bit about that. And maybe there's some other things that are big signs of there is a large amount of speculation going. And if there's any doubt about the speculative fervor, just look at Robinhood. Robinhood is a 7-year-old company, and it just had another new funding round, and now that gives it a valuation of $11.2 billion. Amazing growth for just a 7-year-old company. The amount of new accounts in this stay-at-home economy that have opened up as the youngsters out there, young people that haven't traded the market before in their lives, a lot of people are very interested in having something to do, so they have been opening a lot of new accounts. And since the beginning of the year, there have been 6 million new trading accounts opened in brokerage firms. What's really interesting, Robinhood has half of them. 50%, 3 million new accounts opened by Robinhood in just the first 6 months of the year. And the amount of trading that's going on, well, just in June, that's the last record I have here, the Robinhood processed an average amount of transactions per day of 4.3 million. 4.3 million transactions a day by Robinhood. That is 4 times that of E-Trade, one of the online competitors, of course, just to give you some example. That information reported by Barron's this week, and just a amazing amount of trading going on from those really much smaller accounts. And it gives you some real sense of the amount of speculation that is going on here in these markets and in this world. So I want to kind of look at three different phases here, three different parts to this little piece I'm bringing you, which talks about this speculative fervor that's going on and valuations. We all know about the Buffett indicator, and I want to give you a little picture in here. Well, the Buffett indicator is the valuation of the market to GDP. And we brought this to you before, and it was a couple of months ago, really, where the market was significantly overvalued based on these historical measures. And, of course, now that the market has continued up and lengthened up pretty significantly, of course, it's worse. I'm going to show you a couple variations in there. This is the Buffett indicator, and this is the source here is Advisor Perspectives. This is a great site. I really encourage you to go there and check it out. And this looks at the Wilshire 500 stock index versus the quarterly GDP. And you can see going back here to 1970, there's been really a very wide amount of variation in here. When the major bull market started back here in 1982, this Buffett indicator was at, 34.6%. So that is a extremely low number, and you can see the wide variance that you have in here. Here, when you got up to the, just before the dot-bomb bust, you were up to about 137% of GDP. And then you got into these pretty significant swings in here. When the market broke here into 2002, you got to 73% of GDP. Very big decline in there. And then when the market rallied up to into 2007, you only got to 105% of GDP, and then fell, of course, significantly down here to about 57% of GDP. So where are we now? Well, this reading right now, as of August, is up to roughly 153% of GDP. This is a record level. Now, you might say that, well, GDP is, it's low because of COVID-19, and this isn't really as bad as that. Well, you could say that if you wanted to, but also you could say that the government is pouring money into the economy, and that's the best we could do is the GDP we have right now. Now, we're going to get a bounce in GDP, so this number would come down some as soon as we get some new numbers here from the third quarter, and that will be better. But overall, this shows this extreme valuations that we have right now in the stock markets. That's kind of old news, really, because it was, last time we reported it, it was down here about 140 something or so. So it's gotten worse, and it continues to get worse, or continues to show the extreme valuations that we have right now in the stock market. I'm going to show you a variation of this in here that's put out by Guru Focus, a very interesting site. Also, this is looking at the total market cap, all the stocks out there, versus the GDP. And again, this looks pretty similar to what I showed you, but their reading on total market cap now is 178%. 178% of GDP. This is just an incredible reading in here, and you just have to wonder what it will take, and something will come up where the stock market will begin to correct, and you can get a sense here for what the size of corrections will look like. The real question is, how long will corrections last, and will they be real bear markets? Can you still expect the market to have significant gains going forward over the years like you normally get? What is the average, like about 6% a year? Can you still expect that when you're at this kind of a valuation? Well, we're really talking about an investor focus here, not maybe so much for traders, because traders, you can always get an uptick or a downtick, right? Now you get nothing but upticks. But let's look at what they extrapolate out of this information, and this is really very interesting. So this is, again, GuruFocus.com, and what they this is the valuation zones and predicted 8-year returns. And this is really fascinating because it gives you different variations of the level of the total market cap to GDP. So what we'll look at right over here first is the 5 different phases, as they call it, where you have ratios that are below 72%, and that's significantly undervalued. That's when you could expect to get a very, very good return over coming years. The 93% under there is fairly valued, they say. That's 93 to 114%. This is 72 to 93%. Fairly valued right there. And when you're over 114% to 134%, you're modestly overvalued. And that's when you expect to get worse returns going forward. Over 134%, you're significantly overvalued. And now at 178.6% of GDP, well, I would put a very in there, very significantly overvalued. But the chart below it is extremely interesting, and you'll note right over here, the predicted 8-year returns is a minus 2.9% per year. That's based on these valuations. So when you look at this, you really have to wonder. So we're going to focus on these 3 lines that you see right over here. The red line being if you're trading at 0.7%. And you can see that if the GDP was at 0.7% right over there of the 20-year average, what you expect, and at this case, at this valuations, you would expect that it would be down around 0% per year. Right now, what we're looking at is the average, is if GDP comes out around the 20-year average. So just for clarity, this is around 0.7 of the 20-year average, if that was the GDP now. This is around the GDP average, and they're forecasting now 2.9% of the 2.9% year-over-year return for the next 8 years. And if it were if the GDP really recovered and you got up to about 1.3% of the 20-year, then it would you'd end up with a average of about minus 7%. Which you don't really expect to be able to get there. So right now, what it really says is that 2.9% is the expected return year over year for the next 8 years based on this kind of valuation in the stock market. Just incredible when you look at that, how overbought this is. And this is very formulaic. Your investment return is basically your dividend return plus your business growth plus your change of valuation, the percentage of that. And all of that predicts to a minus 2.9% year-over-year return. And you can see, looking way back over here, that it was pretty similar back in 2000, right over there, just before you had waves and waves of bear market ahead of you. So pretty significant there when you look at this calculation and what looks like, and if we just have an average TMC to GDP compared to the 20-year average, it's just going to give you throwing off a very, very negative forecast when you look at that. One more thing we're going to look at in here, and that is what I'm calling in here the great megaphone that's been forming in here. And last week I talked about the fact that I was going to bring this, the great megaphone. We have been showing the probability of some decline coming in the stock market and correction. I just want you to see these last 3 years in here and the cyclical patterns that are in here. And when you get into these final stages of correction right in here, what you could expect on the downside. So I want you to note these numbers in here. This is the number of weeks of rally. So when you go back here into 2017, 2018, you can see you had a 19-week rally and only a 2-week decline. That was a 12% drop in the stock market. Here you had a really small, it was pretty mild cycle, 16-week rally, about 19-week low right over there, and that was only about a 4.2% decline in the stock market. Here's a 12-week high and then a 25-week low. And that was minus 23% in the stock market. And that was a pretty big break that you see there. Now we'll just look really quickly here. This is, I didn't put in the right number here. So it's an 18-week high, it's about a 21-week low, and you have minus 6.7%. This is minus 6%. Look what happened before the big break that we had early this year. You had a 19-week rally. It fell down to the 24th week, and it was a 35% drop. So here's where we are now. I want you to see 21 weeks off of this low. We have not had a correction, and what this looks to us like is that we're going to have a very, very brief correction. Now, we're predicting that it comes down to the 23.6% because that would be the average coming down to about that level, the 23.6%. That would be just over an 8% decline if it did that to on the S&P 500, about 310 or so. So you can see the extent. This whole piece I'm doing here is about the very extended and speculative market that we're in. And you can see the lengths of the rallies, 19 weeks, 16 weeks, 12 weeks, 18, 16, 19, and now 21. This is the most overextended that we've seen the market get in years, and the likelihood of a very quick and sharp break right out ahead of us is right there, as you can see. It's hard for us to declare this a bull market top. Of course, it's a possibility, but it really looks to us like were we to get a pretty big break in here, whether it's this deep or not, it's going to set up another opportunity where the market is likely to try to get up to those highs. Well, if that happened, what would you buy? Well, I want you to watch the video that our lead analyst did, R.V. Ramachandran, this week, where he showed you something very, very significant in the financials, bank stocks, credit card stocks. There may be some amazing opportunities in there. Make sure you do watch that really fantastic video that he did in stock sectors. If you want to know if this happens, what to buy, well, he gives you a very, very good picture of that. So here you could see this great megaphone being formed in there. What this says to me is that in line with what we saw from regarding the overvaluations and the variations of that in the Buffett indicator, there very well not be very much upside in this bull market left at all, though it probably won't give up that easily based on the fact that this 21-week extreme does not leave much time for correction before it then does move up again. I think that's the important piece that I wanted to bring you today as we look at this S&P 500 chart right there, and this likelihood of a very, very poor performance over this next 8 years looking forward based on that. All right, so now we're going to get into our short-term view for the coming week as we look at 5 different significant markets, and we always do want to be accountable to what we said in the last week. We had a great week, actually. The 5 major markets that we look at were acted pretty much very close to what we thought they would look at. We get little dings off of the dollar, the bond market, and the stock market, but we had basically pretty close on all that. Light crude market, pretty perfect. Same thing for the gold market, pretty perfect in there. So let's get into these individual charts and do our forecasting for the next week. We're going to move out of this chart right over here and move into light crude /CL, and we'll look at the daily chart in /CL right there. So here we look at what we thought would happen. Whoop, that's the wrong chart. Here is the daily chart right over there. So what we thought would happen in this last week was that we were going to get a dip over a couple of some choppy, and then move into a dip for a couple of weeks. And that's basically what we did. I just want to grab this here and make this a little bit more readable for you right here. There you go. So we expected that we would turn down from somewhere between these highs right over here and then move down to these supports over here. We projected that it would get down to about 41. The low right over there is not quite that low, pretty close though. The low is 41.46 right over there. We'll just take another closer look so we can project right there. And what we see in here is the likelihood that the market will come down for another, maybe into midweek next week, a few more downside days. This support zone, you can see, really looks like it wants to hold and then try to get a rebound in here. So the next couple of weeks, we're looking for one more little dip into the support, one more test up into this area, still pretty much in the range. Momentum, you can see, still strong in there. We're getting a buy pending signal right over here, so we don't expect much more in the downside right there as that momentum is strong. And we're going to look for this market to have that little dip and then move up again. Some of the evidence, we're still stuck in a range. We expect the top of it to be about $43.50, the low end about $38, and that comes out over the next few weeks. The risk really grows as we move in a few weeks past here into the September period, where we think we're going to get some more significant corrective downside movement in here in what has been a pretty good upside consistent cyclical pattern. As you can see, as we look at this right over here, that we have 5 almost perfect cycles going on in there, and now projecting for another one that's going to look somewhat similar, but then risk coming in after that. We'll look at the gold market now, and I appreciate all the emails I've gotten from people that have done really well in this gold market. We've probably been better in the gold market than almost any of them over months and months. It has been our best analysis. And we look in here as we just, let's get really close in here because it's a very busy chart. And you can see that what we're looking right in here is some multiple cyclical patterns that we see there. So the one right over here, the silver market right over here, and silver's been really sloppy. You can see that. And a low due in a few days and some attempted rally. The gold market, we had 2 tracks in here. One that if this one really gave us what would be the normal track, but because we had an intermediate pattern that looked like it was weighing on it, we thought it would follow a lower track. It actually tracked a little higher than what our lower track was, but you could see it's pretty much following it. Now, what is pretty significant, you see that blue arrow right over there? We have lost the upward momentum. Now, what did upward momentum do for us in this chart? Well, right over here is where upward momentum turned positive, right around the right around 1790, and then it moved it up $200 in there, and now we've lost that upward momentum right now, and what we're looking at is the likelihood that we're going to be in this corrective period. So we're going to look at the next 2 weeks or so of a declining, choppy market. Where our targets down here are right around 1875 to around 1830, and that's kind of 1830 feels like a bit of an extreme to us, but that is where these supports line up. And we're going to expect that we're going to have a hard time getting much upside in here. That's pretty much inverse to what we see in the dollar, which we think is going to be holding up for a little while in here. So we see this market right now really looking like it's struggling in this resistance, and we're going to call for this modest downward bias for the next 2 weeks. And then after that, getting into a better period over here when we get into September. So 1875 to 1830 is our target, momentum being lost. That is a weakening going on in there. So some of the evidence is that the top really looks to us in place for the intermediate term. That area up around that 2100 really looks like it's done for now, but we think we got another shot at it coming in September, October, based on what these patterns look like. So top in place, silver has downside risk until mid-September. All of that with the silver market probably weighing on this overall metal sector, not really giving us much, but a lot of choppy trading, which has been valuable when you look at this chart in there. So a sloppy period up ahead and a lot of trading opportunity with some modestly lower prices is what we see. So the inverse of that would be the dollar, right? The dollar doing better because they are trading definitely inversely to each other. We have had a little bit of a firming going on in here, but it's not enough for us to believe that anything has really changed. The momentum in here, you can see, turns negative right over here. It was a great signal. You get all of these sell warnings, sell pending right now. So we have this negative momentum that is continuing, and this projection oscillator giving us that signal. And what we believe to be in here is a pretty solid resistance level right here. So this is a 93.70. Now, if it gets above these cycle peaks right over here, it's going to skew this cycle out a bit and even lengthen the time that we think it could rally. Right now, we're just going to look for some modest chop in here and not being able to really hold the rallies, not being able to sell off any significant way over these next couple weeks. We'll call 94, 92 range in here, and that looks to us like the highest probability of what we'll see. We had looked last week for some uptick in here in a minor way, and the fact that it made a lower low here on Tuesday, that dinged us a little bit because we didn't quite think it was going to get quite under there, but we thought it would be the up week, and that's really what we have. So we're looking still at a market that just doesn't look like it can go very far unless it gets over that 94 number. Then we'll be looking at it again. Some of the evidence is that the intermediate low looks like it's in place for the for a number of weeks, but overall no real upside potential that we see in here. The bond market /ZB is you can see in there acting well, very close to what we thought. The bottom came about 2 days sooner than we expected. So again, we gave ourselves a little dinger in there because we thought it would tick down into this low here and then move up, but it ended just before the nested period. You could see the three harmonic families and three minor cycles in the harmonic family, and now in this first cycle. So with that being the case, we would expect, similar to what we saw right over here, that this will get up into this resistance area, curl over, and then have some further rally out there. So looking out for 2 to 3 weeks, we see really an upward chop going on, and a squeezing again because there's not a lot of volatility in here between that resistance and not getting underneath this support level. If it got under there, that would be a bad sign, but we don't really think that that is likely to happen. We'll look for a move up to 179.20 to 180.10 in this area. Outside chance here at 181.03. Then really struggling in there and then coming down again. Not a great pattern in here at all. We really think that yields have peaked. Yields have bottomed and that the futures have peaked. And we're just going to look for small rebounds in here and then more down. That's really the sum of the evidence. Momentum turned negative right over here. That gives us this sell pending. And it kind of tells you it hits resistance here that there's really not a lot more upside that we're going to see right in here. This is a market that is not offering the most opportunity, certainly in trading. The gold market, a lot better. So modest upside, not being able to get very far, and then pulling back again off of that. So that is a look at the first four markets we're going to look at and now we'll take a look at the S&P 500. But not a member? Before we get into that, make sure you go to askSlim.com and sign up for a free membership. If it's the first time you're looking at what we do here, I think you're going to be fascinated by the immense amount of content that we put out, the great analysis put out by our very, very experienced team, and the amazing willingness that we have to really help you to become the best trader that you can be. Your success is our success, and that's what we really want to work on. So if you've never been an AskSlim member, please go and sign up for a free account. You're going to get the Market Week archive, some special videos. We'll put some new ones out there, and you'll be in on some product trials and stuff like that. So you'll get a feeling what it is like to be on our site. Looking at the Market Week archive gives you tremendous amount of learning ability as I go through so many things here in this video. And for those of you that want to learn about premium memberships, you can see that on the front page of askSlim.com. Just scroll down there. And if you have any questions about it, you want to see the demo, any of the demos, and Matt has put together a lot of them, you can write to Matt at askSlim.com. For those of you that are level 2, 3, and 4 members, if you are a short-term trader looking at this S&P market, you probably have a lot of interest in our a video list that you can be sent from Matt, and that shows you 10 of our great videos about learning about shorter-term trading. So Matt can send that to you, or become a level 2, 3, or 4 member, and you can get that. All right, so now let's move over into the stock market. Last week we said we would make a peak in the stock market around midweek and then be moving to the downside. We basically, well, kind of did that. Depends on what indicator you look at, what index you look at. The S&P 500 made its high on Wednesday and then came down a little bit. The Russell, much weaker, and pretty much has moved down most of the week. But the NASDAQ holding the market up very significantly with these huge gains out of Apple. And that has been what's really prevented the market from moving down in any kind of a significant way. So let's move now into the S&P 500 out of the bond market here and take a look at what we're looking at. So I showed you the SPY and the fact that we're stretched up for 21 weeks, which is a historically long period of time and usually brings a very brief, quick correction when you move up for a long period of time. Here basically are those cycles that breaks down that 21-week period. We're in our 6th one right over here, and you can see that's these lines right over here, these lines. This green dashed line over here is essentially the Apple cycle, which has been such a driver in the market that I put it in there. And that is a key thing. The market's not going to break until people are worried about Apple. And the people that are holding Apple for the stock split are probably going to be sellers either Monday or starting Tuesday. So that might be what brings some of this downward movement in that we're looking for. I should make this more readable for you right over here. So the last 2 cycles have been dramatically swamped. What that means is that this upward component we've had in the market, and it's making this this upward wedge that we have right in here that you could see, the upward directional component, which is really illustrated well by the slim ribbon giving you this upward momentum right over here, is so strong that it will not allow these corrections. Getting 2 of them in a row like this, in this third part right over here, is extraordinarily rare. And that's part of when I look at this is why I wanted to bring you that piece that I did about the just crazy amount of speculation that's going on in the market, and this is a result of that, is a market that just cannot have declining periods yet. Now this right over here aligns with that S&P, that SPY chart that I showed you for that corrective process down here to this 23% that certainly feels like an 8% downside move is unachievable based on what we're looking at. And there's been many of these cycles that had only 4 to 6% downside moves. So maybe it isn't this dramatic because it looks to me like we're running out of time. There could be a skew in here, and that is because we're coming into this election. So there are a lot of rarities in here that it's hard for me to speak to, because when you get skews in the market, like I see right over here, it just shows you that this is just one of the strangest periods in my 46-year trading history. So what we're looking for is that, and I said that we thought we would get a peak here by Wednesday and then rolling over. That's this minor cycle right in here. So we're looking for a couple of down days in here, and then another attempted rally, and then it really taking hold right over here, where we get some kind of a correction that is going to feel like a correction. So the chances of getting 3 of these cycles in a row of swamps like this, where there is no selling whatsoever, I just have not seen it. So what does that put it at 0% or 10%? It would be extraordinarily rare, and anything can happen, but I'm going to give that a 10% probability based on what we're looking at. Getting up to this top of this fib extension right up over here, almost 3,400 made on Wednesday, trying to get back up there again, but running into not anything significant yet, but just barely underneath that level. Maybe it's stalling, maybe not. Here you could see this upward trend right over here. If it gets below this level, you might increase the selling. That's around 33.50 here on the S&P 500. Again, we're looking for a decline in here for 2-3 days, an attempted rally that we see right over there, and then the decline really taking hold for about 2 weeks out over here. That is the projection that we have. Each of the weeks that I've talked about, the likelihood of a correction, I have not missed the opportunity to say that momentum has been the story. And we have to always be focusing on that. No matter what the projections are that I bring to you, the market has to prove weakening. Now, right now we have a weakening going on in the market that is not showing on this chart, where you have about 2.5 to 1 on the downside in the advanced declines for the New York Stock Exchange. So while the index is being held up by these few tech stocks, there is a very significant underlying deterioration going on that we see in here. With Apple and Tesla and Nvidia being the ones that are driving the market to the upside, and a 2 to 1 negative advanced decline, this is one of the biggest disparity days that I can ever remember. Again, I'm using a lot of language of historic or ever remember, any of that. Well, my memory's pretty good, and this is just some strange day of disparity that we're looking at here on Friday. What does it mean something? I think we'll know in the next day or 2 or 3 days. But here we have all-time highs, all momentum time frames in extremely strong position, and a likelihood that some kind of a shakeout is going to come in here in this market, and this news that of the huge disparity of these few stocks going up and this horrible advanced decline line really is probably saying something. Some of the evidence, a very narrow leadership now lifting the market, these internals weakening, an intermediate correction incredibly late and likely to give a very brief decline in the stock market before it then tries to rebound again, moving up into the election. That's what we're going to call for. This quick corrective period in here, maybe losing 8%, and based on the strength in here, probably losing less. And then another period ahead of the market going to new highs. That's not the kind of thing that I would like to be saying, because I would like to see some things that are more readable. But as you can see, this is a strange market we're in. Always consider the momentum. It is your best signal for not getting in the way of a market and taking the ride the best that you can. And the Slim Ribbon is one of the great indicators to do that with. If you don't have it and you're a Thinkorswim user, it is free and you can download it on our site, from our site. And we are working on posting this on other platforms also. So we've just begun that work. Arvi's doing a great job on some of that code, and we will be bringing it to some other platforms going forward. So that is the look at the S&P 500, really looking like an incredible situation of really, really small days and low volatility. And don't be surprised if all of a sudden you get a day that looks like this one right over here of some significant selling coming in, and we get this very, very brief correction we're looking for. I hope this was great information for you. We want you to always consider the market information that you need for your trading is available at askSlim.com. 500 plus videos that I've recorded on so many different aspects of trading. All you have to do is become a level 2, 3, or 4 member, and you'll have access to all of that. And our team works incredible hours, early in the morning, sometimes 5 in the morning to 10 at night, to bring all of this amazing information to you. I want you to be so incredibly careful. It is so crazy out there. And I'm always wishing you great trading.